Well, hello. My name is Anthony Seccaro, founder and president of Providence Financial and Insurance Services, located right in the heart of the San Fernando Valley in Woodland Hills, California. I'm also host of the Providence Financial Retirement Show, which airs every Saturday on AM 870 KRL Lay the Answer. And every now and then I try to put out a market update with regards to what's relevant to you, and I primarily do this for my clients to keep you up to date with my thoughts and what's going on in the economic world. And if you're a client of mine, thank you for your business, thank you for your trust. We certainly wouldn't be in business without you, and we don't take it lightly. And of course, if you're not a client of mine, you're certainly welcome to watch this. And if you have any questions, you can always call us, and be more than happy to have a quick conversation with you. But I try not to bring you the same information that you hear on the news. We all hear different things, and I don't need to repeat what you hear on CNBC or CNN or whatever news channel you decide to watch. What I really try to do is take what you hear out there and bring it down to earth and put it into your reality, into my client's reality, and talk about how it affects them. And what prompted me to do this video this time is that today is day number 2 of General Electric, GE, being out of the Dow Jones. You may have heard that yesterday it got kicked out. You may not have heard that. Some people pay more attention than others. Some people don't care. But how does this affect you, and why am I bringing you a video about GE being kicked out of the Dow? Well, I think there's a couple of things that you can benefit from this, as we have. First, GE's been around a long time. GE was founded in 1892, so what is that, 125, 126 years that GE's been around. Well, GE was one of the original members of the Dow in 1896. And then in 1907, or from 1907 to now, GE has been in the Dow for 100% of the time. Now, the Dow Jones has 30 different large companies in there, right? And of those 30, they've all turned over except for GE. GE has been in the Dow consistently since 1907. So what is that, 110, 111 years, right? And I think the big deal about that is the economic environment, and GE's business has been around for 125 years, has changed enough to where it's caused it to no longer be able to be part of the Dow. And I don't want to say that it's failing, but it has cut its dividend multiple times. Its share price has fluctuated dramatically. And now its share price is less than 50% of what it was a year ago. That's right, 50% lower, a little more than 50% lower than what it was a year ago. Right now, GE's trading in around the $14 range, between 14 and 15. And a year ago, 2017, it was at $30. So year and a half, somewhere in that range. And yet, this is not a new company. This is a company that's been around for a long time that's struggling to survive. They're breaking off a lot of their divisions. They're selling a lot of things. They've got a new CEO. And yet, all of that leads to the conclusion that they are no longer worthy of being in the Dow Jones. So they got kicked out. And where I think that can be important is a lot of people have relied on GE for many years. And GE, at one point, was like the Apple. If you bought GE in 1980, okay, and you held it for 20 years, that stock went up 1,500%, just like Apple. And yet, the reality is, if you look back over just the last 15 or 20 years of history, right now it's trading in the call it $15 range, a little bit less than that, but call it $15 range is where it's trading in. And if you look back a year, it was in the $30 range. But if you look back to 2012, again, it was in the $15 range. So from 2012 to a year ago, it went up, doubled, and then dropped back. And if you go back to 96, again, it was in the $15 range. So if you bought the stock in 96 and you held it till now, what is that? 20 years, right? 22 years of zero growth. Now, it did pay dividends, a few percent. So that was good, but the dividends have been slashed, but no growth on the share price. Now, think about that for a second. You would have gotten a couple percent dividends, but back in the mid-90s, you could have bought a 20-year CD that was going to pay you more than 6% interest. And you didn't have to worry about all the fluctuation or the potential for loss and take on all the risk that you have to with an individual stock. So I think we can learn from that. Over the long run, it's been good, but things have changed. And I don't want you to get complacent. And I think that would be the theme of this video, is a lot of people are getting complacent with what's going on out there. What's going on with the stock market in general. From really 2009 until now, almost a decade later, the stock market's done nothing but go straight up. And there's been several times, 4 times to be specific, where the stock market has stepped back by 10 or 12%, more than double digits. And really, just within a week or 2, maybe 3 after it stepped back, what happened is it came back. And it got back to either the same level it had been before or crept up to new record highs. Well, in January, the Dow Jones hit a record high, 26,500 to be exact. So that's its record. Then in February and March, we had a couple of bad months. The Dow Jones gone up and down, but where that has led us to the middle of the year, June 27th, today, to be exact, 2018, is we're still down about 10%. Not quite 10%, but we're still down about 10% for the year. And I remember in January when the market dropped, and late January and early February when we started having these initial problems, we were getting a lot of phone calls. Our phone was ringing off the hook. What do I do? Do I freak out? Do I panic? And people were worried because we had a hiccup in the market. And that's gone away. People have become once again complacent with where the market is, thinking, you know what, I'll just ride it out. And why should they not think that? Because that's worked from 2009 to now. But the reality is the buy and hold strategy is what's been propounded out there. What's been pushed. And buy and hold simply means that you're going to ride it out. So people just think they're going to ride it out. And psychologists call this normalcy bias. Normalcy bias. What normalcy bias is people tend to think that the way things were yesterday is the way that they're going to be today. And we know that that's not true, but we tend to think that just because we were alive yesterday that we're going to live today. May or may not be true. And that also has to do with our finances, has to do with our markets, has to do with our investments. Just because investments were okay yesterday or yesteryear or yesterdecade, we tend to think that everything is going to be okay today. And you and I both know that that may not be true, but that's normalcy bias. And buy and hold just blends into that. I'm just going to ride it out. And I've heard a lot of people say that. And if we knew for a fact that this was just going to be a 10% bump and the market was going to come back, then riding it out would probably be the right thing to do. But do we really know that for a fact? We have to go back 20 years in the market. And, if you know me and you've watched any of our other videos, you know that we've done an extensive history or stock market history, an extensive research of the history of the stock market over a 200-year period of time. And I've got videos on that you can go back and I would encourage you to watch. But if you just look at the last 20 years, from 2000 to 2018, 18 years to be more specific, in 01, we had a 50% crash. In 08, we had a 63% crash. And now the market's recovered. And we tend to remember what's happened in the last 10 years. We don't tend to think about the fact that the impressive growth of the market in the last 10 years has really just brought us back to even when it comes to the losses that we sustained in 08 and 01. And if you were to have a portfolio in 2008, call it a typical stock portfolio that represented the S&P 500 or the Dow Jones, and you had a portfolio in 2000, I think I said 2008, I meant 2000, so going back 18 years. If you had a typical stock portfolio in 2000, and you just held it, and you just rode it out, we're just going to hang in there, we're going to ride it out like Wall Street wants you to think. You care to guess what the rate of return of the stock market has been between 2000 and 2018? The answer is less than 4% per year compounded. Less than 4% per year compounded. That's it. That's it. And back in 2000, you could have got a 5 or 6% CD that would have outperformed the stock market over the last 18 years. 2 crashes, 2 recoveries, less than 4%. And most portfolios that are invested in the stock market are not matching the stock market. There's fees that are dragging you down and so on. Most people are spending 0.5% to 1% of net fees. So that means that if the stock market was a little less than 4%, then your return was probably a little less than 3%. Does that sound like it's worth taking all the risk for a 3% rate of return over a period of 18 years? Probably not. Probably not. And I'm concerned. I'm concerned because nothing goes up forever. The stock market's gone up almost 400% in the last 9 years. That's phenomenal growth. If you've participated in that, congratulations. What I don't want you to do is I don't want you to participate in the downside, the reverse of that when the market crashes. And I've heard some people recently say they don't really think the market is going to crash. No. By the way, most people don't think that. I'd say 1 out of 10 people I talk to have that inclination. And in all reality, I think it's their optimism that's speaking, not realism. And yet a lot of times these are the same people that own the Amazons, they own the Apples, they own the Netflixes. You know, the market in some of these tech companies, which people are really gravitating towards, is just absolutely overvalued. It's just insane the amount that people are willing to pay for some of these stocks. As a matter of fact, I give you a couple of examples. Yeah, Amazon, right now when I looked, was trading at a little over $1,600 a share, $1,671 a share. And Amazon has a price to earnings ratio of 210. Now, that may not mean anything to you, but let's look at it this way. If you had, let's say that you owned a business. I don't care, whatever business you want, donut shop. You owned a business, and that business was giving you $100,000 a year of income. Okay? And you had someone come in and offer you $2 million to buy your donut shop. Okay? Let me ask you, would you sell it? And I can tell you, I've asked this question dozens or hundreds of times, and the answer is always yes. Why? Because $2 million for a business that's only making $100,000 a year, that's expensive. That's expensive. But the nice thing is that if you take that $2 million and you divide it by 100,000, you come up with 20. And that would be a price to earnings ratio of 20. And the nice thing about price to earnings ratios is all you do is chop off the zeros, and that 20 represents that you paid 20 times what the annual revenue was or the annual earnings was of that ice cream shop. Okay? So 20 times. So if you wouldn't buy an ice cream shop for me for $2 million if it was netting $100,000, well, let me ask you a really stupid question. Would you, in fact, give me $21 million for that ice cream shop? Of course you wouldn't. It'd be silly. $21 million for a business that's earning $100,000 a year? That'd be silly. But guess what? If you buy Amazon stock, that's what you're doing. You're willing to pay 210 times the price earnings ratios of what the revenue is, what the profit is on the company. And I said those two different things. It's actually revenue. Okay? So what the revenue is. Why would you do that? The reason that people are doing that is because of one thing. They expect that it's going to make money. Netflix, another example. They expect that it's going to make money. In the Netflix example, the price to earnings ratio is 328. 328. That means that you would be willing to pay me $33 million for my donut shop that's generating $100,000 of revenue. But guess what? People are flocking to Netflix. People are buying Netflix. And it's almost like 2000 all over again, where if you didn't own any tech stocks then, it was almost taboo. Like, what are you thinking? I don't want you to get complacent. I don't want you to feel like you missed out in the 2017 run of 25%. Again, over the last 18 years, the market's produced somewhere less than 4% rate of return if you just bought and held, just looking at the market. I don't think this is a time to be complacent. I think that when you take a look at what's gone on, we know nothing goes up forever. This 10% drop is different than the 3 other drops that we've had over the last 2 or 3 years because it's always come back after a week. The market's always come back to new highs after a week or 2. That hasn't happened this time, and it's got me feeling like it's 2007 all over again. And GE has proven that nothing remains the same forever. And I want you to remember that. This last 10 years is not likely going to continue. Could we be wrong? Absolutely. But the odds are against that. The odds are for another major correction. And you just have to be careful. And if you want to have a conversation with me and you're not a client of mine, feel free to call me. You can reach us here at 818-887-6443, or you can just contact us through our website at providencefinancialinc.com. If you are a client of mine, know that your money that we're managing is protected. Why? Because you're not invested primarily in the stock market. You're invested for interest and dividends. So when the stock market does have a problem, then your money's protected. Does that mean that it's not going to fluctuate? No, it's definitely going to fluctuate. But regardless of the fluctuation, your income is going to remain consistent. You have to remember, we're focused on the income and dividend, not the share price. So again, thank you for your business. Thank you for your trust if you're a client of ours. If you want to do a client review, if we haven't done that for a little while, or you have questions about anything I said, please don't hesitate to call my office and get that set up. Thank you. I hope this has helped. God bless.